2024 was a year of reckoning for the financial sector. The Reserve Bank of India took unprecedented action against various financial entities, signaling a shift towards stricter compliance and consumer safety, and driving home the message that abiding with regulations is non-negotiable. The ball was set rolling early in the year with action against Paytm Payments Bank. The RBI barred the bank from onboarding new customers or accepting any deposits, effectively shutting down the payment bank's business. It based this action on repeated non-compliance by the bank with KYC norms and governance deficiencies. But it wasn't Paytm Payment Bank's first brush with the RBI. However, this time, the central bank had run out of patience.
Such restrictions which we impose are always proportionate to the gravity of the situation.
In March, two firms, IIFL Finance and JM Financial, faced business restrictions. IIFL, a key player in gold loans, was restricted from issuing new loans because of violations in gold valuation and loan-to-value ratios. For JM Financial, the offence was governance lapses in financing IPOs and bond subscriptions. In April, Kotak Mahindra Bank was ordered to halt onboarding new customers through its online channels and suspend new credit card issuance because of weak IT systems. And the crackdown extended to microfinance as well as new age lenders. In October, RBI barred 4 non-banks, DMI Finance, Ashirvad Microfinance, Navi Finserv and Arohan Financial Services from sanctioning and dispersing new loans, citing excessive pricing practices and non-compliance with regulatory guidelines.
We found a number of NBFCs charging exorbitant interest rates.
Right.
Interest rates going up to 40%, going up to 45%. Now, and who is the borrower? The borrower is he is a man of small means.
Right.
And these are not well-off sections of society.
Restrictions on one of the NBFCs, Navi Finserv, were lifted in a little over a month, on IIFL Finance in 6 months, while those on JM Financial products were in place for 7 months. The others, however, are yet to free themselves of regulatory embargoes. So why this sweeping regulatory action?
The Reserve Bank has taken up this as one of its focus areas to create awareness as well as to ensure adherence to good corporate governance practices.
The RBI's tough stance has been met with praise and criticism. Some quarters allege it is being overly punitive, especially towards fintechs. For instance, soon after the action against Paytm Payment Bank, a dozen startups penned a letter to the government arguing that such measures could stifle innovation and hurt the broader fintech ecosystem. RBI says the numbers don't support this argument.
Out of over 150 banks, over 9,000 non-banking financial companies, about 1,500 UCBs, and various other entities that we supervise, stringent actions have been taken only in a handful of cases.
RBI believes these actions will serve a dual purpose. One, it's a signal that the cost of non-compliance will be too high to ignore. And two, it promises consumers greater transparency and protection. For financial entities, this is a wake-up call they cannot afford to ignore. What is becoming increasingly evident is that this is a new, stricter, no-nonsense RBI that expects and demands compliance with its rules and regulations. And while it is willing to give financial entities time to get their house in order, its patience is not endless. In Bengaluru, Ritu Singh.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18 Now streaming live 24/7 on YouTube.
Thank you for watching us on CNBC TV18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.